Good afternoon. Welcome back to Real Conversations. I'm Neil Howe, guest hosting for Keith McCullough. We've got a wonderful show today. I'm joined by the one and only Raoul Pal. As many of you know, Raoul is the CEO and co-founder of Real Vision. He's a Goldman Sachs alumnus and a former hedge fund manager. And as you probably also know, he's a much sought after market strategist. Raoul, thank you for being on our show.
It's great to be here, Neil. We finally get to meet. You've been on Real Vision a few times.
I have.
And I've never got to meet you, and I've been jealous of Grant.
Well, Grant's a great guy. Your neck of the woods, or I say your neck of the islands. So
yeah, Grant's on a plane more than I am, but yeah, we both live in the Cayman Islands, which is not a bad place to live, particularly at this time of year.
Yes, Grant lives out of a suitcase, I'm sure. I mean, he travels about 250 days a year. This is really exciting. I was thinking about how we were going to do this when we kind of first planned it, and we have so much to cover. I know that you've done some recent shows on the retirement crisis. I've talked about some of the same things on my shows. One thing, Raoul, what I'd like to do is to go through this maybe in the following order. One is to look at long-term fundamentals, in population, employment, productivity, you know, sort of the long-term constraints on where the economy is going, kind of all, and all of those things constrained by sort of the political economy in the world. And then we could move from there to the business cycle. Where are we shorter term? When's it going to break? What does it mean to be light cycle? Or I don't know if you believe Fed Chairman Powell, we're still making mid-cycle adjustments. But anyway, we can talk about the timing of the business cycle. Then we could move on to the financial cycle, if there is such a thing, and talk about how markets are going to impact how things are going to break. And then finally, and this is going to be my favorite topic, is to talk about the political cycle. And I know you talked a little bit about it on your recent shows. And that is this whole new mood toward authoritarian populism, both on the right and the left, not just in America, but around the world, and how that is going to make its entrance and what's going on. So, gee, there's a lot to talk about, and and just your thoughts, I guess, to start this rolling.
Yeah, so look, to frame my long-term, because I look at things in the long term, the secular trends, and then I look at the cyclical, as you rightly point out, and then down to what its impacts are, and then what its knock-on effects are going forward. So it's kind of very much within the framework that you've set. So long term, as I laid out in that retirement crisis video, is we're at the end of, somewhere close to the end of a secular cycle in debt, equity ownership, and a number of key things. And I think most of those, in my mind, where I differ from many is, and probably not from you, is I think much of where we are today, the secular imbalance or even a bubble in many respects, has been driven by this baby boomer population all acting within rational thought. So most of these people, this largest generation of all time at the time, had no offsetting generation because of the war. So as they walked into their first job and their first house and their first car, their incremental consumption was, you know, similar to what we saw today when China came onto the scene in the early 2000s, late 90s. It dislocated prices, and I think that caused a large part of the cause of the inflation that happened in the late 70s, early 80s, was these people coming of age and just starting to incrementally buy, and that hadn't happened before. There was no offsetting generation. Now, that's all fine, but then what happened was, after that, is once they got into their 30s, and again, this is very much influenced by your thinking, is they got into their 30s, in their 30s they start saving for a rainy day or retirement or whatever, because they're starting to earn income. And that was the advent of the 401k. the start of the decline of the defined benefit pension contribution system. And so it became an onus was on the individual to make their savings. So money piled into the stock market at an unprecedented rate, because again, there was no offsetting generation that was selling stocks to them. This was basically all new purchases. And it accelerated in about 95 onwards as the advent of the index fund took hold and money poured into that as well. So we saw this, and leading into 2000, we now saw these baby boomers at the age of 45 years old with a huge speculative equity portfolio and unprepared for a recession. And as ever, the recession comes along and it wipes 50% off the stock market. That hurt people, but they were young enough to buy the dip. But their mentality had been changed from thinking, okay, the equity market is now not the safe bet that I basically had from 1982 to 2000 with 1987 in the middle and a small pullback in 1990. They now thought, okay, this is something different. So the Fed had cut rates, so they did the rational thing, which was, okay, how do I save for retirement now? Well, property is relatively cheap for me, and it was relatively cheap. And interest rates were so low that they piled into that too. Again, all making rational choices, but the madness of crowds meant that it made things untenable and household debt exploded. The next wave of that was obviously that bubble bursting and an unwinding of the household debt bubble to some extent. Now we're left with a situation where most of them don't invest in the stock market directly, but their pension managers are. And they're driving the last part of, I think, of this demographic bubble. And that the last, well, probably the part before last, which is the credit bubble in the US, as corporations buy back their own shares and issue debt to pension funds who are giving it to the. Also, these same people, their pension fund managers are taking excessive risk to close the funding hole left by those two recessions where they never made enough returns and interest rates keep falling. So that's the other key part of the equation that I look at, is the falling of long-term interest rates driven by demographics and the increase in debt.
Right.
And I think all of those things come together. And the last part of the big secular cycle is this dollar issue where the dollar will not go down because there's too much borrowing. So all of these have come together at a big point, and that's kind of how I see it.
Yeah, that's it's interesting. You know, I look at very carefully at how all of these generations are doing by cohort, and the generation that made out best, the what's been called the lucky generation, is the silent generation. It came right before the baby boom. They were relatively small in numbers, so there was a great deal of demand for their labor back in the 50s and early 60s. They were all veterans because of Korea, so they all today have veterans benefits. And you just kind of go down the list. They bought their first homes just before the 70s kicked in with stagflation, so they all paid negative interest rates. And then when they began to move into midlife in the early 1980s, that's when the valuation of the stock market reached its all-time low back in August of 1982. Interest rates were at all-time highs, and they were the ones who started saving. They rode this incredible boom for 3 decades, and guess what? The last cohort of that generation, born in 1942, reached age 65 in 2007. 2007. So that's timing, right? That's perfect timing.
My parents were that cohort. And so
there you go.
So my dad retired at 60 in 2000. And then what happened was obviously the equity market collapsed and he lost a lot of his retirement savings. Then it got to 2007. Luckily, I'd managed to get him into bunds at 4.65%, which was great. But by the time they came to roll over in 2010, bund yields were at 0. Right. And so even for him, and he was part of that lucky generation, but the tail end, it kind of killed him twice. So there was still some impacts, I think.
Well, there is, and obviously it's going to get worse. I mean, obviously too, low interest rates after the GFC and quantitative easing was very good to this generation because then they were all in these assets, particularly fixed income, which just kept on going up and up. Anyway, that generation has done very well. I've done many presentations on the graying of wealth, on just how incredibly affluent today's seniors are.
Here's a quick point to that. Is I spoke to one of the guys at the kind of UBS ultra high net worth management groups. The average age of an ultra high net worth at UBS, I believe, is 80. Wow.
You see, there you are. And that's my point. That's my point. And you look actually in the SCB, Fed data on, they do every 3 years on asset holdings, and 75 plus Americans still have the largest per capita holdings of equities. I'm not talking about fixed income. Anyway, equities, they're still holding that stuff. So this is what, and late wave boomers and Xers like to think of this great generational transfer. But as you have pointed out, and I have as well, there's a tremendous inequality to this generational transfer. I mean, if you look at, the various kinds of inequality, right? The inequality of consumption is probably the least kind of inequality. Even poor people have to eat, and even, rich people can only spend so much. Inequality of income is steeper. Inequality of wealth is much, much steeper. But the one thing that's the most unequal of all is inequality of bequests. And there it's incredible. The difference between the median and the average bequest is a couple of light years wide. So for example, the mean bequest, the average bequest, from the silent generation, early wave boomers to their kids is over $1 million. The median bequest is something like $30,000, right? And that's the difference. And I think when everyone talks about this great wealth transfer, yeah, but it's all going to Muffy and Duffy. You know what I mean?
That's right.
And that's the problem. And actually, this whole issue of whether or not interest rates will come back up again now that the boomers are beginning to retire. This is the whole phase of life bulge. That effect is going to be tempered by the fact that increasingly much of the savings no longer has any phase of life dimension because it's Warren Buffett money. I mean, you know what I mean? It's very wealthy people and they're investing in the next 5 generations of their family, right? So there is no perceptible dis-saving for this group. Yes, there's dis-saving for the middle class, there's dis-saving for the upper middle class when they actually start retiring, but that's no longer as dominant as it used to be as back in the 1970s when we were a somewhat more equal society. The Gini coefficient, at least on assets and income, was less.
Yeah, I agree. I think it's a bit of a red herring to look at that generational wealth transfer. We had similar in Japan, and we never really saw the great impact of that wealth. Well, the Japanese just don't die, so it keeps going on and on and on, and they over time deplete some of their savings assets. But, I think the point being is when you actually break it out by median versus average in both the older generation, the silent generation, and the baby boom, it is so skewed to this ultra rich, when in fact, the average baby boomer has like 190,000 to his name into total assets to retire on. They've basically got about 10 years worth of income. That's right. It. There's no interest rates for them to deal with. And people haven't come to terms with the fact that they're going to have to accept a different standard of living or dramatically affect what they do. There's no amount of the stock market going up in the next 3 or 4 years is going to help these people.
Yes. Well, let's take a look at some of the big demographic constraints on the long term that I sometimes talk about. Josephine, I don't know if you could pull up chart 3 here. This is what I call the generation-long slowdown in the working age population. And you can see how we're on this incredible decline, right? We're reaching almost absolute zero by the year 2021. This, again, is the consequence of boomers retiring, Raoul. It's sort of the flip side of what you're talking about. And also a very small generation, kind of late wave millennials and kind of the post-millennials coming into the workforce. And you can see in the next chart, Josephine, if you want to look here, This is without historical precedent. And for everyone who likes to think that, when Trump came into office, that he was going to sort of redo the 1980s, the early 1980s with Reagan, you can see that Reagan benefited from one of the most incredible growth rates of working age population, right? That was the boomers coming of age. They're coming into the workforce. So when Reagan was president, he was enjoying a 1.6% GDP wind at his back just from more warm bodies in the working age population. Look where we're going today. We're going into this decade-long, what I call a super trough. And in fact, looking ahead, the next 50 years, we're never going to see labor force growth like we saw in this 20, 30 years ago. This next chart, and I just have a couple more charts on this. This simply looks around the world, and you can just see the sea change, right? Take a look at these differences wherever you look in the world, and notice that the United States is not particularly bad. We're still growing. But how about Russia? How about Europe? How about Japan? How about China, which shows the biggest delta? If you want to look at the difference between 1970 to 2017, and then take a look at the next 30 years, there is no delta on demographic change more rapid than China. That red guard generation is all retiring, and those one-family children with those 421 families is coming of age today. And lastly, if you want to know what's driving it, it's actually not longevity, it's falling fertility. That is what's driving this. We're not having kids as much. And I have on the purely demographic constraints on this. I'll just close this with my last chart here. And this is in a presentation I did a while ago, and just asking the question, are we actually relatively favorably situated in what I might call a demographic quad 2, meaning that if you look at population, the compounded annual growth rate in the working age population by affluence, it's a negative correlation for the obvious reason. It's rich people that stop having kids, right? But in that spectrum, the United States and the other Anglo-Saxon economies, which tend to have higher fertility rates and also tend to have higher immigration rates, we're looking at United Kingdom, Canada, Australia, the United States. Obviously, Israel, for cultural reasons, is a huge outlier here, is generally relatively favorably situated. But if you want to look at East Asia, the more advanced economic tigers, or look at Europe, you're looking at a much more depressing scenario. So, Raoul, I want to pass it back to you for your comments.
Yeah, look, I mean, I've been following this whole wave through Japan, through Europe. And look, there's no surprise the Japanese stock market topped out in 1990, and then Europe topped out in 2000. And look, the only surprise was the US didn't top out in 2007, I would imagine. But now coming to the average baby boomer retiring, I think that's significant. We've also known over time that as the population ages, we've seen that the growth rate of GDP has fallen along with exactly those charts, and that we see the same with bond yields as well across the world. It basically follows that demographic. I think China is the very interesting one, and we can impute, much worse trends ahead. I think that's super interesting. I also asked myself the question about 10 years ago. I said, okay, we know this is all screwed. So what is the answer? And the answer somewhere on the top left quadrant is there are many countries that are growing in economic power over time, that have young populations and an average population age below 30, with very little debt and very high savings rates. I call those generally the monsoon countries. They tend to be all around the Indian Ocean. They tend to be mainly Islamic countries, with India, Singapore, South Africa being the key exception in that. And those countries look the complete 180-degree opposite. So as from a demographics perspective, if I were to say, okay, what does this mean for the West over the next 20 or 30 years? I think your chart shows very clearly that the ability to generate economic growth within that is going to be very difficult, and particularly return on asset prices, considering they're at all-time record valuations, both in credit markets and equity markets. But then I look at a country like India, and sure, India has its ups and downs, but what is the probability of having a secular wave behind you as Indians start to save and invest? And they're piling money into the stock market over time, and it feels like the US in 1982. And so I very much use these as part of my core secular framework. I think it's incredibly important, and most people don't really understand the power that the demographics has on everything from GDP growth to asset prices.
I agree with you. India is that juggernaut that everyone keeps waiting to happen, right? It's soon going to be the most populous country in the world. It will soon surpass China. It's still growing. It still remains desperately poor, and it still has a pretty tiny middle class. But that could change. And those who believe in democracy, those who believe in a kind of a pluralistic society, they speak English. They have a lot of human capital. You would think that they would turn up. That is a great long-term expectation, along with much of what you pointed out in Southeast Asia. The Philippines is another country you could add to that list.
Indonesia, the Philippines, exactly. Malaysia,
yes.
All super interesting.
Yeah, but they have to turn the corner on the whole productivity dimension. And it's interesting that not too many countries have repeated the example of the Asian tigers. We waited for Latin America to do it. And the demographic dividend, they too experienced lower fertility, but they never caught on the greater productivity wave.
The question is, Neil, we shouldn't expect the past. So whatever's coming is the future. So whatever was the productivity, the globalization that was basically the Asian tigers wave, right? As capital from the West flowed into the East, was a huge driver of that. But that's in reverse right now. And in addition, I think that as it reverses, it's going to be a more complicated world to project forwards, because there has to be something different to come.
Well, I agree with that. And history always moves in unexpected ways. And I do think that the complacency...
So is something like the robotization of the Japanese workforce, is that a productivity miracle that we are waiting to happen? We don't really know, but I know it's not going to be from labor arbitrage,
right?
Which is what it was.
Yeah. I know. I agree with that. Let me turn to another long-term constraint that's been much talked about. Obviously, if you don't have employment growth, you can still have higher GDP and obviously higher affluence with productivity growth. So we could show chart 8 here. This is the current trend, and this, frankly, has been a huge disappointment, right? And this is as important as employment growth in determining real GDP. And as you can see, we had a period in the late Clinton years and the early, OOs, the G.W. Bush years, of higher productivity, largely attributed to the introduction of computers and laptops and the internet into businesses. But it's been very disappointing since then. And this, too, is a real constraint on all GDP projections, on budget projections, fiscal projections, standard of living projections. One of the reasons why people don't think that their kids are going to experience higher living standards. And the reasons for this are varied. I have a list of these things. I don't know if you want to show the next chart, but this has to do with everything from inadequate investment in infrastructure to the sectoral failure of success. Increasingly, this is Baumol's cost disease. Those sectors which experience the fastest productivity growth are destined to become the smaller sectors over time. And those that experience zero or negative productivity growth are destined to have ever greater share of employment over time. And this is something that William Baumol pointed out many years ago, and I think we experience it. If you look at education, healthcare, real estate and construction, social services of all kinds. You look at this enormous area and growing area of our economy, which arguably, I would say, particularly for healthcare, probably has negative productivity growth over time. You have a real problem. And one of the areas that to me is most to blame for this, or at least is complicit, is a growing theme that no one really talked about back in the 1990s or even in the early 00s, and that is declining business dynamism. We have a decline in startups. We have a decline in job churn. We have a huge, catastrophic decline in geographic mobility. People aren't moving anymore, particularly young adults, millennials. Declining rates of company startups, firm turnover, declining number of total firms. You look at it. I actually have a whole hour show on this, but a lot of it comes to its apex in this whole problem of growing market concentration and the fact that increasingly businesses are favored. I like your reaction to this, Raoul. Businesses that are favored. I mean, if you talk to Warren Buffett, he says he likes companies with moats. Moats around them that protect them from competition. You look at Peter Thiel's new book, 0 to 1. He says he's looking, any entrepreneur, he looks for monopolies. No one looks for a competitive business. Well, everyone wants a monopoly. And you look at Jack Welch. He used to say that he wants businesses that can be absolutely dominant, that can be a permanent incumbent in an industry. And right now, at the same time that you see this low and declining real rate of risk-free interest, you see the rates of return on these incumbent businesses remains very high. And I fear, and this is something that can actually feed into this whole populist thing that we could talk about later, but there is a disjuncture in our economy. That is to say, it's hard now to break into new industries. You're either surrounded by patent thickets, or you know what I mean. There's something in the way.
Well, I would step back even at a higher level and say, okay, what's driving that productivity issue? And if I look through your list, I could answer debt to many of them. And the more debt there is, the harder it is to become productive. You've got the productivity miracle out of debt growth, and we've seen that with the Chinese economy too. That's kind of gone ex-debt growth. And we see that in GDP. Each dollar of debt added to GDP produces less and less GDP over time. So I think that's part of the productivity issue. Also, obviously, companies, because of the tax issues in the US and low interest rates, the US corporations are choosing to buy back their own shares as opposed to invest. So that drives down productivity over time as well. And that's not going to go away until it gets changed. And I think that'll be one of the changes that comes with a swing in populism, because I think it's something that has to happen. But the other thing is crucial. It's related to the same thing, which is access to capital. So what you're hearing from Warren Buffett and Peter Thiel and all of these guys is only certain people can get the capital. So you can try as hard as you want to go and open a cafe, which was the old style of setting up a business. You can't get any money. Nobody will lend you money. Banks do not lend money for small businesses.
Right.
So how do you get money? Well, you now have to have that gazillion-dollar idea that has a moat around it, and you have to have been connected within the industry. You have to know who the players are to access the capital. So what we're seeing is a narrowing of capital availability to more people. And I think, so we're seeing capital going into buying back shares and less capital being allocated to a broader range of opportunities, which means it's harder for most people to get. It makes the economy less productive over time because everybody's looking at the same opportunity.
I agree. I mean, you can't even break into politics without a few $1 billion. Isn't that right? I think that's what we're now beginning to see.
I mean, that's true, though, right?
Yeah.
It's even within the hedge fund industry, an industry I was in, when I was first in that industry. So I've been around and about that industry since 1990. But by the time I was running a hedge fund, you could still get capital. And so the insurance companies and pension funds and endowments would allocate to a broad range of managers, some of which may have had 100 million under management, which was deemed to be relatively small at the time. Then a huge explosion came from the pensions industry again, as ever, driven by the same demographics, which was they wanted hedge funds to look like bonds. They wanted a low volatility, but slightly higher return. They wanted to look like a junk bond,
Right.
but with less catastrophe risk in it. So they forced all the returns down and everyone became an asset gatherer. So all the asset gatherers grew in size. So people like Bridgewater and a bunch of others accumulated huge amounts of assets, and it meant that nobody else got capital. And it's getting worse and worse to this day. So even people who are fantastic traders and great investors can't get any capital because they're not big. So investors will only follow where other capital is. So it's becoming, even though we talk about this massive washing around of liquidity from the Federal Reserve, but we have to talk about the same issue of the elites versus the non-elites within access to capital, as well as it is for all the other issues.
I agree, but I think regulatory capture, I think the increasing use of what I talk about patent law, which I think increasingly hinders rather than helps competition. I think the growth of the so-called natural monopoly, that's kind of your Facebook, Google phenomenon. I think all of this is just accentuating the thing you're talking about.
So here's a thought that I've been toying with and a few people have talked about. Look, I think Facebook and Google should be broken up and will be broken up. And I think that much like breaking up AT&T or Marbell at the time, what you did was unleash a whole bunch of smaller companies, break apart monopolies, and allow more people access to that locked-in capital from the larger corporation, and it tends to offer great opportunities. I mean, out of the split up of the big phone company came all the mobile phones.
Yeah,
and that huge business.
I totally agree. Well, you kind of mentioned debt, and particularly corporate debt, and the rise of leveraged lending and all of that, and the covenant-light loans, and the huge run-up basically of corporate debt, and the lowering of quality of debt over this entire business cycle. So that's a good segue to talk now about the business cycle, right? Where are we in the business cycle, and what are you looking for? I did a piece, this was probably about 2 months ago, on recession indicators, and I went down, I don't know, I must have done 120 of them, but I had my 15 favorites. But I'd like to start that a little bit and get you to talk about favorite recession indicators. I can go down through some of mine that give us a good place of where I think we are in the business cycle, but maybe I could,
Yeah, I mean, I spend most of my time looking at this because the secular framework doesn't change almost from decade to decade. So when you look at the business cycle, it's the key driver of asset prices. So if I look at the year-on-year rate of change of oil, copper, equities, bond yields, the Korean stock market, emerging markets in general, anything, they're all basically driven by the business cycle. So where are we in the business cycle now? Well, this is the longest business cycle in all recorded US history. We've seen a couple of outliers in the last 20 or 30 years, one in the UK and one in Australia, which both skipped a recession at some point. I think if I look at the indicators that I look at, I use the basic one is the ISM. You can use that. And the ISM is around 50, which says we should be growing at about 1% GDP growth. But when I look at forward-looking indicators of many things, stuff like the JOLT survey, the yield curve is the classic example of the business cycle. There are so many indicators that suggest we are at the point of recession or very close to it. And my point has always been about this is that recessions come from a slowdown in the business cycle, but they actually are crystallized by a larger event. Now, I think the tariffs were the thing that actually did it. We broke supply chains around the world and we're still recovering. But now this coronavirus on top really doesn't help. So any chance we have of some sort of midterm bounce is about zero now, I think. So my view is we're going into recession. Now, I think it's this year and next year, there'll probably be some sort of euphoria around the election because both parties, whoever gets in, is going to spend a lot of money on fiscal stimulus, and I think the Europeans will too. So, and the Chinese probably will as well. So there's going to be some euphoria in the middle of the cycle, much like there was in the 2000 cycle. And so that's what I think is happening. Now, what it means is we can already see it playing out in bond yields. Bond yields are falling almost on a daily basis. And I've been part of that trade for a long time with the ethos of buy bonds, wear diamonds. I've spoken to Keith about it many times. I've also been very interested in the dollar, because as the world slows down and world trade slows down, what you find is the dollar, there is a global shortage of dollars. I think the BIS put it at $13 trillion the world is short of. So if the oil price falls, there's less dollars in circulation. If world trade, which is currently negative, falls, there's less dollars in circulation. It keeps driving the dollar higher. I mean, even today, we're seeing the dollar almost breaking back over 100. So we've got on the DXY. So we have this issue that the dollar is driving up because of the debt dynamics and some of the regulatory issues that was caused by the banking system. That in itself lowers global growth. That in itself is lowering bond yields. It's inverting the yield curves, and the Fed have had to start cutting already. Everybody else is starting to think about stimulating more. And the reality is at some point the equity market's probably the final leg of this. And this, unfortunately, dovetails exactly when the bulk of the baby boomers hits retirement age. You know, the issue that we talked about is if you want to wipe 50% of a retiree's savings, this is the time you're going to do it.
Yeah, I agree. And the frightening thing that you pointed out in your kind of retirement crisis video, which I liked very much, is reminding people that equity markets don't always bounce back, right? Look at Tokyo. Look at Germany and France now. The United States is the only one that's always bounced back strongly. But that's, you look around the world, that doesn't always happen.
So Neil, this is a key thing. So why did the US bounce and others didn't? When 2008 should have killed off the cult of equity. Well, the cult of equity is dead, because if you look at individual households, they don't own equities. Yes, they have it in their pension plans, but as you said, the super rich do. The reality of the situation is the entirety of all the equity purchases that have gone on by the corporates themselves, buying back their own shares.
Right.
Everything else is a net negative.
Yeah,
then there's been a switch
right.
between, and there's the switch between active to passive. So indexation has created a forced, because you're corralling more assets into a smaller number of companies. So that's created those two things alone. Everybody else has been a net seller, including foreigners. So you're killing the cult of equity off. If you change so what is it that allows corporates to buy their debt? It's pretty simple. It's cash flow. Cash flows are also correlated to the business cycle. So when the business cycle goes negative, cash flow goes negative. And we're seeing that in many companies already. So that means they stop buying back their shares. The other side of the equation is who's the buyer of all that debt? Well, guess what? It's the same baby boomer pension. And the issue is they're being driven at state level by corporate tax receipts. And they are also driven by the business cycle. So as tax receipts go negative, the buying of corporate bonds stops by the pension system, and also corporations stop buying back their shares. So you end up with a situation where the two most widely held assets by the entire pension system come to a halt as soon as the business cycle goes negative. That's a really, really key issue.
I totally agree. The buybacks and the borrowing for the buybacks is really generating, the push up in equities, and people don't understand that. And it's not the growth in borrowing that you have to worry about. It's when the growth stops.
Exactly right.
And that's actually happening now. I mean, if you look now, you find that it's kind of peaked out. It's kind of plateauing right now. And that's when you really have to worry. I totally agree, too, that it's a very dangerous sign when you have a high and rising dollar, falling commodity prices, a slowing global economy aside from the United States, and a Fed which keeps talking about we're fine for now, right? So yeah, you're not going to get a midterm bounce again. Jerome Powell claims we're kind of a midterm correction, so that's the word he would use. Let me just give a couple of slides here and show some of my favorite light cycle indicators. Josephine, you might show chart 22. This is basically showing what happens when an economy runs out of workers. This is our age-adjusted employment to population ratio. We are now above where we were in 2007, and we're about either at or above where we were at any previous business cycle peak. People don't realize that because you have to adjust the employment population ratio to account for the fact that this huge group of baby boomers are now mostly or increasingly past age 65, and only a very small generation is now in midlife. When you correct for the change in the distribution of the population and look at each individual age bracket, we're now above where we were in 2007. So I don't think we have a lot of workers left. If you want to go ahead, another one of my favorites, Raoul, and this is just your point about the term spreads. This is chart 26. And this simply makes the point that if you want to look at a long-term recession indicator, it's been correct in 10 out of the 11 recessions, right? That's the term spread. We went into a inverted yield curve back in April. And I look at this rule and I basically say 6 to 16 months after an initial inversion. It usually goes into and out of inversion several times. And as you can see, if you want to look ahead one chart here, you can see that it's kind of going into and out of it. So we're going to see it skip into and out. And typically what happens is it'll go into inversion, the Fed will cut, it will come out of inversion until the long end slowly sinks again, and then the Fed will cut again. So I think now what we're waiting is for the Fed to cut. It's going to go out of inversion, then will come back. It's like a stone that skips several times on the water before the recession hits. And maybe my favorite one to look at this in the next chart, this is 28. We're just talking about all-time favorites. This is the fundamental disjunction between what the economy looks like near-term versus long-term. And so you see an eerie parallel between the consumer confidence spread, and that's basically the consumer's view of what the economy looks like near-term versus long-term, and the actual 10-year to minus 3-month term spread. They actually track eerily and incredibly closely over a business cycle, and they basically show you where you are in the business cycle, I would add. And this unequivocally would indicate that we are indeed late cycle.
Yeah, I agree, and I think the yield curve is telling you the Fed needs to cut rates.
Totally, yeah.
And so I think this coronavirus, will force their hand. I think they can use it as an excuse to do it as well, because they need to steepen the curve, because this is terrible for the banking system as well. So the chances are, I think that they may well cut 50 and 50 again over the next 6 months as they try and deal with the global slowdown. And I think that is what steepens the yield curve. And obviously it goes along with the recession, because that's why the Fed are cutting rates. So I think you're dead right. This is all to play for, and this is what's going on.
Right. Well, it's Jerome Powell, I think, has kind of eased the way on that. He's talked about how he doesn't even consider raising, and inflation is so subdued. And he's made remarks. I think he's pretty savvy, and I think that both Powell and John Williams have sort of, I think they're waiting for a chance actually to do this. I'm going to move, if you don't mind, to some Q&A. I want to get some.
Okay.
Let's see if I can read this here. I'm going to just start from the top. We got a lot of questions. I'm just going to start from the top here, and we can both comment on this, Raoul. So I'm going to just start from the top here. Is the coronavirus pandemic the black swan event that will put the U.S. into recession, and how might it impact the U.S. fall elections? You actually commented on that briefly when you talked about this coming after the tariffs.
The thing about black swan events, we don't know what the actual outcomes are.
That's why they're called black swan.
Yeah. We can't predict it happening. We don't know what the outcome is. We don't know the magnitude, right? If we knew the magnitude, we'd be able to. I think it falls into the category of the potential. I think the economic impact is enormous, much bigger than the market's yet understanding. And I think without going into, how the virus is spreading, of which none of us know anything in reality, but the probability is this sticks around for another 2 or 3 months globally at best. So at best, we got another 3 months of this. That makes it a 5 or 6 month economic event. Well, that's a global recession. I mean, it's almost impossible for it not to be. So I think it is very real, hence why I think the Fed will cut maybe 50 and 50 again to get rates back down to essentially zero.
Yeah, I totally agree. I did a note recently on the coronavirus and what's behind it. I think that it's actually extremely transmissible. It's very different from SARS in that respect. I don't think quarantining is going to do anything to spread, to thwart its spread. It's not all that deadly, but if it's only 1/2 or 1%, and half of China gets it, and ultimately half of much of the world gets it, that's still an enormous death toll.
Well, so Neil, I looked at just a simple thing is the current growth rate of the virus outside of China is roughly what it was in the beginning of the Wuhan incident when it first started. It's basically doubling every 7 days.
Right.
Now, the numbers are small now, but in 8 weeks' time, that would be 1 million people affected worldwide.
Right.
So, people have to understand compounding and how fast that works. So the point I've always raised with this is I don't know the answer, but I know how to trade it. And you have to trade the panic. You trade ahead of the fear because nobody knows anything and nobody's going to know anything probably until April or May. So in which case the market's going to have to trade on blind panic and headlines. So that makes it and I think the Fed will have to do the same. And so that makes it a relatively easy trade for fixed income because it has to price in the potentials for something bad for the time being. And so that's how I've looked at it. Also, as world trade drops further, and simple things like, for example, China under the trade agreement was supposed to buy more US goods. It needs the dollars. It's buying less goods from, let's say, a country like Brazil where it bought soybeans from. Brazil needs dollars. It's now dollar starved because China's taken the dollars from elsewhere and world trade has fallen. So the whole thing is creating a setup that I think is a little more toxic than people understand. I think the dollar may be the thing that breaks it all. Sell
on the rumor and buy on the news, right? So, and you're right, it's all rumor. I often remind people that if it's only killing 100 people a day, just to keep, I'm a demographer, right? So I have to keep things in perspective. In China, there are approximately 50,000 or 60,000 people who die every day anyway, right? I mean, you've got a population that large. So if it were only 100 a day, this wouldn't even be noise. You wouldn't even be able to see it. It would be an invisible stochastic pattern. I actually don't think it's just 100 a day. I'll just tell you, I don't think it's that. And I think it's spread much more widely.
But yeah, and I think the other key thing here is, I think the point you've raised, right? And I keep telling people, forget, as what you're saying is dead right. This is why people talk about the flu and all this other stuff. The reality is China's outsized response shows how scared they are of something like this.
Exactly. So that's the point.
It prompts an outsized response from every other country because the political fallout from not doing this is even worse.
Yes.
So behaviorally, none of us are going to get on planes as much. At the margin, we're all going to change our behavior, even though the death rates are super low for people who aren't old and aren't male. So the reality is, it doesn't really affect anybody unless it turns into the Spanish flu, and it's still possible. We don't know, but the behavioural outcome is everybody is going to be affected by it because nations are.
I agree with that, and I don't think it will turn into the Spanish flu. But anyway, I agree. This last part of the question was how is it going to influence the elections? We haven't talked much about the elections, what you see coming up, but the timing is interesting, right? I mean, if we are reaching a turning point in the business cycle, you go ahead another 6 months, right? And people are voting.
Well, look, so I think what very much resonated about your work is here we go. And I realized it was after 2007 that I thought, well, the next cycle may well be it, because we've talked about in this conversation that the debt cycle is probably the last bit. The corporate debt is the big issue here. Central bank bubble, well, that's about to finish as well. and you've got the business cycle finishing, and you've got this shift of a population from productive workers to net divestors. So you've got this enormous structural shift with a new population coming in. I mean, you couldn't ask for a better Neil Howe tick list of opportunities to create a fourth turning.
Yeah.
So, and you've had, exactly as I think you talked about and several other people have talked about, there's a great guy, D. Smith, who's a good friend of mine, D's always talked about, well, first what they do is look backwards. So look at the Trump strategy and the Boris Johnson strategy. They're basically looking back to the past. We can go back to that. And that's appealing to the older voter, is there's a rate of change going on of which you don't understand, you're not comfortable with, but we can turn back the clock, of which obviously we can't. So we can't throw out all the immigrants. We can't go back to 1950s England and watch the cricket on the green and drink pints of warm beer. It's gone forever. And that whole world is up for change. So when you have an election, you now have a mighty polarized country, especially in the US, and you have a potential for an upset again, I think. And I think the upset within your framework could be Sanders and teaming up with somebody like Elizabeth Warren and AOC and the whole progressive movement together. Well, that would change almost everything that we know today as creating some of the big structural problems that we have today as well. Or at least it's a solution. I don't know what the outcomes are.
Yeah, I remind Republicans of how delighted Hillary Clinton and the top Democratic leaders were back in 2016 when Trump was nominated. Do you remember that? Oh my God, they're going to win in a cakewalk. Do you remember that? I mean, here's a guy who believes in protectionism and isolationism. I mean, these words that couldn't possibly win in a modern day and age, right? And I see all these Republicans saying, oh, socialist. No one's going to vote for a socialist. He's beating Trump in a lot of these head-to-head polls. I don't know if you go on Real Politics. Take a look at head-to-head polls. And I think he's a lockup for the election. I think he's a lockup for the nomination, I should say.
Well,
I think it's going to be a fascinating contest. And I'll tell you something, from everything that I monitor, Trump himself, he's the one he most does not want to run against. He would much rather run against Bloomberg. And he says it all the time. He says Bloomberg just bought himself into the election. Bernie Sanders has real supporters. And that's the world Trump knows, right? A polarized nation with real supporters. It's going to be fascinating.
The problem is for him to attack Bloomberg is relatively straightforward, because Bloomberg is a centrist and an East Coast billionaire and all of the things that the zeitgeist is against. Sanders looks more like Trump in many respects.
That's exactly. He is the postmodern candidate for the left. Trump is already the postmodern candidate for the right. Let me get to a couple of other these questions because, my gosh. Okay, we have another one. For younger investors in their 20s and 30s who are worried about the potential crisis looming on the horizon, demographics and pension shortfall, assets at all-time highs, coronavirus, et cetera, how would you recommend approaching asset allocation for long-term growth? Okay, here we're asking you, Raoul, as an asset strategist, right? What do you say about asset allocation for someone in their 20s and 30s?
Okay, so I have a different view to many. My first view is you are your best asset. How you leverage that in an entrepreneurial world can make or break everything for you. So if you have abilities to leverage your own abilities for income that can last your lifetime, whether it's because you happen to be a good chef or whether it's because you have the brain that allows you to create a business and run it, use that first. The biggest investment you can make is that. Then secondly, okay, at some point this dollar is not going to keep going up. It may in fact be broken up in some way, shape or form with some sort of accord or the rising of digital currencies and a number of things. That will mean that emerging markets at the end of this cycle are going to be almost historically cheap. This is the second largest underperformance of emerging markets in history, and it's getting very close to being the largest. By the time the dollar has finished its move, emerging markets are going to be cheap as chips. So you can buy markets with great demographics, great tailwinds, high savings, all the things you've ever wanted, ever dreamed of, the same that the silent generation got, you're going to get them all over again. They're just not in America. So that is the great allocation for me. And the other thing, so that's why I talk about countries like India or Indonesia or Malaysia, or there's a bunch of these, Philippines, all of these. I also like countries like Iran and Morocco, and there's so many countries that really are interesting to me.
So you're going to get you're going to get your first bargains abroad before you get them here at home. Yeah, that's probably right.
Because I think you will agree that the likelihood of developed markets recovering until this baby boom generation is through the hose pipe is not high. So in which case you end up with these low markets that trade up and down with the business cycle but don't go anywhere. And I think that is where we're due to go for the US. But the emerging markets do the opposite. They'll just take off. And then finally, I'm a big believer in the future financial system being built, because I also do think it's built around the fourth turning narrative, which is the whole digitization of assets, the tokenization, Bitcoin, and the whole thing that's going on there. I think that is a once in a generation opportunity to invest in an entirely new system, not one that we've seen since, I guess, the rules-based global order system was put together and globalization took off, allowing people to manufacture goods in different countries around the world and trade easily. So I think this is a really big opportunity.
Can I ask one other thing, Raoul? If we do have a in a recession scenario, what's likely to happen to the long bond here at home?
So I think bond yields go to zero. So I think
so that's an opportunity as well in terms of just the business cycle.
Yeah, for the business cycle, the shorter term opportunity, I've been banging the drum about this forever, and I've come on and spoken to Keith about it numerous times, is, just buy bonds. Buy bonds because the capital gains opportunity is huge, let alone the protection opportunity.
Here's another question, just to follow up on that. What do you think about real estate and precious metals, gold and silver?
Precious metal, gold and silver, I think if we're moving into a situation where we're going to have much more monetary largesse when we run out of interest rates, I think gold and silver do well. I think that's a known narrative now, and I think people understand it. Real estate, I think, is a very complicated narrative, and I think you've touched on this a lot. I think it's a bifurcated market for a long time. I think the stuff that the baby boomers want to sell, nobody wants to buy because they don't want to live there. And the stuff that the millennials want to buy just keeps going up in price and they can't get hold of it. So it makes it a very, very difficult market. And there is no market clearing for 6-bedroom houses in rural New Jersey because the millennials don't want to live there. Right. So what you've got is this holing out of the baby boom places. And we saw this in Japan, all over Japan, is the whole towns. We see it in Spain, we see it in Italy, see it in Greece. These whole towns just completely devoid of anybody under the age of 70 or 80.
Right. Well,
property, and so you get a bifurcated property market, I guess.
Yeah, the only exception, of course, are all the millennials living at home, because that's the co-housing and the co-sharing narrative. You see that particularly in Southern Europe. I mean, you just look at Italy and Spain, where you've got just incredible ratios of homes with adult children living in them. The reason they do that there is that 15, 16, 17% of the budgets of those countries are going into pensions, which are going into these households with older workers or retirees. The kids have to go home to get a piece of that. It's sort of like pilot fish.
Well, it's just
coming home.
Even not from that angle. It's just, look, if you look at the combined issues the family face, the kids can't buy the houses. They both have to work. They can't afford the babysitter or the nanny. It's difficult to afford the cleaner, and they're working 24 hours a day. Their parents have an asset, which is a big house or a bigger house. They have some retirement savings, and they have an ability to alleviate the workloads which cost money to hire third-party people to do, and additionally, they have the ability to work part-time, which is what we've seen of the older cohort. So net, it's a huge beneficiary for everybody if people move into multi-generational households, particularly people with young kids. It's a game changer. It changes the entire retirement demographics of the parents and the entire future opportunity set of the millennial kids. I mean, it's a no-brainer.
I totally agree. I've told everyone that, don't be disappointed or don't be disgruntled by this. This is probably the best news for the long-term political economy of the United States, because it allows us to maybe pare back on all these third-party transfer payments between young and old if they just simply live together. There is nothing could be better news for our long-term, liability situation in our economy. I have one other, I'll just answer it. I have another question here. Someone said, what book would you recommend as a follow-up to The Fourth Turning? I say, I get calls every couple of weeks from my agent. He wants me to come out with a new book. And I will just say it's questions like that that will speed me up. Right now, I'm very busy at Hedgeye, but I absolutely do want to write this next book where I go ahead another 10 or 20 years kind of into demography and into the generational cycle. Raoul, this has been great. I don't know if there's any last message you want to add about what you're doing or how you're following up.
Yeah, just a quick thing. It's a shameless plug for Real Vision. I think many Hedgeye people know about it, but we've got currently a 2-week special I'm very passionate about, as you can tell, which is about the retirement crisis and what people can do about it. But Real Vision, has it has the world's best financial video content, bar none. We have an extraordinary roster of great people. And right now we've got a special offer that runs till this weekend, which is you pay $1, you get 3 months access to Real Vision. And the price is about to actually go up in March, and you lock in the old price as well. So if you've ever thought about signing up for Real Vision, now is the time to do it. It's just $1. So just go to realvision.com or find us on Twitter and get hold of that.
Yeah, at Hedgeye, we love Real Vision. So I certainly visit it often. So thank you so much, Raoul. It was a pleasure speaking with you after all this time, reading about your work and listening to you. So I'm glad we finally had the time to do this.
Yeah, I'm really pleased as well. I've been desperate to sit down with you, so at least over Skype, but one day we'll have a glass of wine and chat properly.
All right, Raoul. Thanks so much.
Okay. Perfect.